Portfolio Builder members, welcome to our Wednesday Trade Alert. See who we have live here today. If you're getting this recording, remember if you do subscribe to the channel, you can join us live every day at noon Eastern. We'll start out by reviewing the most recent trade alert, look at how our balanced portfolio is performing in these uncertain times, and then start looking at market forecasts and the top news I've collected over the past 24 hours. That's helping us figure out which direction the market is headed. And if you are there, good morning, Ryan. If anyone else is in there live, please say hello. And we'll get this show started. So, had impeachment scare yesterday that gave the SPY a small sell-off. We've had the repo madness confusing the investment crowd. And then before that, we had the oil shock. So stocks have had some catalysts that have been holding it down, but my expectation remains the same. I think the SPY is most likely going to new highs into October on the news of a trade deal with China. Perhaps just a small deal, but I think they're going to pick up a lot of agricultural products. They're already starting to do that. We just had Trump tweet that we may have a China deal sooner than expected, or sooner than you think. And so we'll look at all the noise and what exactly is going on in a minute. But first, let's just review how to exit the previous trade, and then we'll go into a short little piece about how our program works and go from there. So the previous trade was to sell. Let me zoom in on that. The previous trade alert was to sell to open the September 25th, 2019 302 call, which was only an 8-cent credit. And this is because we were expecting the SPY to break past this very difficult $300 resistance level. And to play it safe, just in case anything crazy happened, we owned a put option at $2.95 for 33 cents. So we actually were dipping below $2.95 this morning, and then a lot of news hit the wire and market has rebounded. But what that means is our worst case scenario going into this trade is we get $2.95 a share because we bought the put, and on the other side of the coin we stop enjoying profits on the SPY once it goes above 302, and this was expiring today, 9/25. Let's take a look at how you get out of that trade. Buy to close the call, sell to close the put. You get a 22-cent credit. And again, we almost used our insurance in today's trade alert. However, the SPY did pop up. Here's how to audit these returns yourself. Track the change in price of the underlying, and then track the change in price of the options. Now we're doing caller options. That means we sell a call option and buy a put, depending on which direction we believe the underlying asset is traveling, up, flat, or down. We can adjust those option contracts to take advantage of what we're expecting will happen. And so if we do look at the results from the previous trade on Monday, the SPY traveled from 298.23 down to 296.38 when we closed out the previous trade today for a loss of 85 cents. The caller option cost a debit of 24 cents to put on, and when we closed it out, we received a credit of 22 cents for a 2-cent loss. Combine those together, and we lost $1.87 on 1,700 shares of the SPY, for a loss of $3,179 on this most recent SPY trade alert. However, we have a balanced portfolio that is, to a degree, very hard to lose money. We would actually need the SPY and TLT to sell off dramatically while predicting they were both going up at the same time to lose money. In general, that's just not the way the markets work. In general, the SPY goes down, the TLT goes up, and vice versa. But in the long run, they're both going up together. And I believe this trend will continue as we look around the globe at interest rates and QE popping up all around the world. We can look at the weakness of foreign currencies in China, Japan, and Euro, and everything is pointing to a repeat of 2017. If you remember what happened that year, U.S. stocks had a huge rally while emerging markets suffered dramatically. And it looks like we have the exact same setup occurring right now. So if we do look at the rest of the trades that were placed during this same time period, we go back to last Thursday, where we have 3,700 shares of the TLT. Now remember, TLT costs half the price. Oscar, no, I am not looking to go bearish on the SPY at all. In fact, our outlook remains the same. 315 SPY target for November 1st is my expectation. Okay, so SPY costs about twice as much as the TLT, so it's very simple for you to understand. For every 100 shares of the SPY, you should have 200 shares of the TLT, and you can see how that played off very well for us today. And actually all week. Now the TLT did sell off, so our profit yesterday on the TLT was greater than it is today. But currently the open profit on the TLT, now this does not look at the callers, but we can enjoy the profit on the TLT all the way up to 143, and it's down to 141 or so right now. We're up $2 since last Thursday on the TLT for a profit of $7,733. Oh, cool. Scotty's in his car listening. Very good job, Scotty. And I'm actually going to look at the boot camp trade alert. This will be exclusive for boot camp members in terms of buy and sell alerts. Of course, I pretty much give you guys what I'm expecting in terms of market directions in this free YouTube, just to get the exact trades and timing is where our program. So anyways, stay tuned, Scotty, as I do have potentially a trade for our boot camp members if the farming deal breaks down. And I'm now getting more and more confident that we will at least get some agricultural purchases from China. So we may be delaying that trade, but it is still my highest conviction trade once we get the catalyst. So we'll take a look at that. Our silver trade from Tuesday, which was yesterday, is down 12 cents on 8,900 shares for a loss of 1,068. Our GDX is a buy and hold position. So the previous trades we just reviewed are all income trades. We take these very diversified products. The SPY is 504 companies. TLT represents the tax receipts of all of America. SLV is spot silver, so that's not so much a diversified product. But on all of those trades, we are selling call options and buying put options. This makes the trade much less risky than a simple buy and hold strategy. On the silver play, we're down 12 cents times 8,900 shares for a loss of 1,068. Our GDX, which is the only buy and hold aspect of our portfolio currently, with no options protecting the position, that's the gold miner ETF, is up $1.63 or positive $6,283. Now, the previous trade alert on Monday for the SPY was also down $1.97 for a $3,349 loss. Add that all up, net result is $6,420. If we scroll down a little bit, we can take a look at the asset allocation strategy. On Monday, we have Monday, Wednesday, Friday, we're trading the SPY, and you can see we're sitting on a 9% return with 37% of our assets trading the SPY. And I do think this will catch up with the rest of the portfolio in the next several weeks, as tensions do seem to be dramatically easing between U.S.-China. Now, there are some other things that concern me, which we'll take a look at. Primarily, this repo madness is the biggest risk that is not very well understood. After probably watching some 8 hours of interviews about this from all the Fed experts and banking experts, basically all I can derive is that it appears some banks from perhaps China, maybe PBOC, perhaps in Europe, the HSBC, or in Germany, Deutsche Bank, could be having some serious money problems. And we can look at those countries having serious problems. Their currencies are devaluing. So I think those are the weak links in the financial system and not American banks. So that is the big risk, and that's why we're also carefully tracking those three banks to look for weakness. You won't really see it in their stock price right now. So a very interesting time. Tuesday, we are trying to add some extra profit to the portfolio with a higher risk and higher reward strategy. So the Tuesday program is optional, currently represents 11% of our portfolio, and it's been a little slower lately. We had some dud trades on Facebook. We had a small loss on USO, and now we're back to silver, where we have had some substantial gains in this portfolio. And I do think that this could be a pretty long-term trade for us, although one of the things China promised was to potentially buy U.S. oil and gas. So we have the Aramco IPO. If we can get this trade tension out of the way, I would be ready to go back to USO on that Tuesday trade with all the different catalysts out there. So we have Iran ready to retaliate. Their president's saying they're on the brink of disaster. We've cut off all their financing. Are they ready to create some more drama and attack Aramco again? Aramco's IPO is back on the table, and supposedly they've miraculously fixed their refinery in just under 2 weeks now. So get all the banks printing money, trying to spur economic growth, creating projects to prop up their GDPs, have China flood the U.S. oil market with purchases on top of agriculture. So I could see us going back to USO on the Tuesday trade. Precious metals crypto portfolio is 10% of our portfolio. For those of you who don't like crypto, we've said just buy GDX. And for those of you who do like crypto, we've had a huge gain all year on Bitcoin and Ethereum. Now, we had some pretty crazy sell-offs in the crypto Ethereum space at the same time when gold was rallying. So to me, it seems like there must be a bank that has gone insolvent and had to liquidate everything, most likely yesterday, because we saw a lot of things sell off. Anything with a high PE multiple sold off rapidly yesterday, and risky assets like Bitcoin and Ethereum, which should be somewhat correlated to gold and the Treasury Market, was selling off even more rapidly. So very, very confusing. I'm still long the Bitcoin and Ethereum. In our portfolio, with that 10% allocation to the buy and hold, we only have 1% in Bitcoin and 1% in Ethereum. So worst case, if those went to zero, our total portfolio loss would only be 2%. But in the same breath, with the current pullback of 10% and 15%, that barely puts a dent on our return in that part of our portfolio. So not worried about that. And today may be a great day to jump into those assets with the right allocation, Bitcoin and Ethereum. Our bond portfolio has been on a tear. We've made profits to the up and downside. Now, when we want to profit from something like the TLT dropping in value, we sell an in-the-money call and then buy an in-the-money put. And so we were able to catch the sell-off in the bond market during that period of time, which was probably our best trade of the year in terms of difficulty predicting it. Then we saw the repo madness come in. We saw the Fed buying up treasuries, and Powell came out last Wednesday and said it's time to consider the organic growth of the balance sheet. Of course, Bernanke said the growth of the balance sheet in 2008 was going to be a short-term fix, and we're going to get it right back down to where it was. And so they say one thing, but the best way to predict the central bank is to look at what the other central banks are doing. So that's a summary of what we do, how we do it. You can look at our total return and you follow the program. Our worst month was in July, -1%. The reason we lost money that month was because I was predicting Trump's tariffs would hit in July. They hit in August, so we were a month early on that. Been waiting for it all of June. But again, when we were wrong, we only lost 1%. I'd also point out S&P 500 lost a lot of value, something like 5% in May, and we had a return of 2.2. So our goal in this program is to deliver small but safe profits. So that's a look at our results recently for those of you who've been following the trades. I'm going to read a few testimonials. We're going to start collecting these on Sundays every week and add to it. These are just people literally just reaching out to me without even asking for a testimonial. Oscar says, Jason, no one is dead on, but you're very close. Thanks for sharing your knowledge. Tom says, this is the best service I've ever subscribed to. Gains are small, but really consistent. Stephen Lane says it's a conservative strategy that makes money even in bear markets. And then here's a stream of text messages from one of our clients, Kirk, who's been following the program for quite some time, making money on Microsoft, Cisco. That was back in June. Great job on the TLT, September 1st. Here's a trade he actually made a little more than we did. He was up $8,500 on his TLT. Of course, he has a large account. So we'll start collecting more of those every Sunday from our members. So keep a lookout if you're a member for a request via text message and email. Sundays, we're going to try to start building up a nice testimonial file. Here's our disclaimer. And so a quick little piece about our program, and then we will jump into the hot news of the last 24 hours and market predictions. 99% client success rate. No other advisory has even a 10% success rate. And I'm saying success rate in that you can get the same results as the advisory. We don't win 99% of our trades, and we're not trying to do that. But what we are proud of is a system that people can actually follow. And this is because you know exactly when the trades are released, you know what we're going to trade, and you even have a great idea of what I'm expecting to happen. Extremely easy, on-the-go daily retirement income trade alerts. So we're not trying to take on large amounts of risk. We're trying to generate consistent returns for retirement. Dean says it takes 30 seconds a day. Who's counting? My dad says it takes him less time to take out the trash. And I ask you, why make investing complex? Don't you have better things to do with your most precious asset, your time? My promise to you is I will protect your assets and show you how to pick the low-hanging fruit. Our put options hanging right below the SPY and TLT ETF make it impossible to lose very much money, period. And again, we're aiming at income and safety, not growth or speculation. Target return on investment is 1 to 2% a month, and we've only had one losing month of negative 1% and an average of 2%. Watch this daily YouTube video and you'll know exactly the rhyme and reason of each trade alert. Now, if you are getting today's content, but your email does not have today's trade, you may have expired your free trial. So call Dean at 505-322-7515, and let's get you started as soon as possible. We have a paid member webinar coming up today in 30 minutes, and tomorrow is our group webinar for everyone. Don't forget to subscribe to the channel and click the little bell so you can get our daily live stream straight to your YouTube account. And if you download the phone app like Scott has, then you'll be able to watch it on the go. Okay, let's take a look at what I've collected today. Okay, so we can see the dollar index continues to get stronger, and this is despite the Fed lowering rates and printing money. So that tells you our monetary policy remains stronger than the key currency trading partners, Japan, Euro, and now, to a degree, China. And this is also against gold rising. So we can see the rest of the world is really having a rough time, and at the same time, we're firing on all cylinders here in the U.S. Now, you could argue we have too much debt, everywhere from the Treasury market to the corporate market to the consumer market. But until that credit bubble pops, this reinforcing cycle of corporations buying at low rates and buying back their own stocks is going to be very difficult. If the government's creating huge amounts of debt and flushing it through the economy, that's going to make the GDP look strong. And with the Fed keeping rates super low, consumers still have access to expand their lines of credit. So this all seems to be a bubble that will continue. Big drama this week and last week is the repo operations. And again, this is a overnight loan that is recycled. It's not cumulative, and it's continuing to be oversubscribed. So there is a high demand for dollars in the banking system. And the people who do have dollars, now remember, the banking system's supposed to have 1.2, maybe it's $1.5 trillion of reserves, and they're not willing to loan to these different institutions that are trying to get overnight lending. So I believe this is potentially Bank of China, the HSBC, big bank in Europe, who had been working with China, or maybe the Deutsche Bank, or perhaps a smaller set of banks that are related to those three. So we're seeing this demand for dollars continuing, and the collateral is being treasuries and mortgage-backed securities currently. New home sales spiked dramatically in the U.S. as mortgage rates dropped, showing strength in the U.S. economy once again. This is alarming, but somewhat normal. And think about it. You know, we got Zuckerberg selling his shares today while their company is doing stock buybacks. What a great deal. Sell your own shares to your stock buyback at all-time highs, and then if there's a crash, you can just buy it right back at a discount. Treasury Market is having blistering auction recently. That was yesterday. So it's very bizarre. The people who have to pick up the Treasury auctions, the primary dealers, are not letting go of their Treasury positions. Instead, they're building huge stockpiles of these Treasuries. And that's bizarre because they could be instantly flipping them into the market for a profit. So that is something that is confusing a lot of people and potentially part of the problem with this repo madness. Now, if you listen to Jeffrey Gundlach, he's looking for the yield curve, which is inverted, to steepen before we would get a recession, and that would mean that long end of the Treasury would spike higher with rates. So if we go look back to October of 2018, when the sell-off in stocks began, the TLT was down in the 110 level. So if Gundlach is correct, and a long-term bear market would be preceded by a surge in the TLT, which means the TLT would drop and the yields would go higher, rather a surge in yields on the long end of the curve, then that's something I'm carefully watching for. So far, TLT is still at very high levels, which indicates to me there's really nowhere else to go with your money to invest. So really, SPY is your only option. You've got crashing economies around the world. You got negative yielding bonds. So it really makes no sense to go anywhere else except for equities in the U.S., as everything is still firing on all cylinders here in the States. Meanwhile, China is preparing to buy U.S. pork. They're buying soybeans. So it looks like they potentially are going to at least give in partially to the trade demands of U.S. We do hear Trump saying over and over again he won't accept a bad deal. But will he give us a Christmas present and delay the December 15th tariffs in exchange for some massive purchases from China? I think he will. Now, if he doesn't, we know exactly what to do. And we'll be talking about that in a minute. China had some upset commentary after Trump's speech yesterday at the United Nations, where he really ragged on China, the whole laundry list of items, even brought up Hong Kong. Peter Schiff was celebrating yesterday. Gold's up, Bitcoin's down. That's his favorite thing that can possibly happen. But I don't think Bitcoin or Ethereum is disappearing anytime soon, so I would say buy the dip on those assets. Now again, 2% of our total portfolio is holding Bitcoin. We got 1% in Bitcoin, 1% in Ethereum. The China Beige Book says everything is crashing in China. And everything I've been following looks very bad for China. They're definitely struggling. They're having inflation. Their CPI is at 3%. So they're at a point where they can't stimulate their economy very easily without creating more and more inflation. And so they're in a tough spot right now. Iran willing to give reassurances, accept small changes to nuclear accord if U.S. returns to deal and lifts sanctions. So potentially a peaceful deal in the books here. Also, United Nations, Trump reinforced that he was not going to take military action on Iran. And just the sanctions. We saw some new sanctions today related to Chinese companies trying to sneak in Iranian oil. So we're carefully watching that. Looks like the impeachment scare yesterday is going to blow off, and I don't think anything will come of it. Got to remember, the Congress is controlled by the Republicans. Trump has given the hawks, I think, record amount of money for the military, so it seems unlikely that they would impeach him with 2/3 vote. So at this point, I'm not concerned with this, especially after the transcript was released this morning. China's preparing to buy agricultural products. The repo rate seems to be under control again, although they are looking at increasing the quantity. But this does seem to be a problem that's fading. Chinese Bank of China says their GDP is at 6%. I think that's much higher than it is. And it used to be more like 14%. So the rate of change of the GDP for China is crashing rapidly. And I think that's more important than just saying, oh, America's got a 2% GDP while China has this hot 6%. Because if we look at the acceleration of the drop, this does seem to be very, very problematic. Now, China can go build worthless buildings all over the place that no one lives in, and as long as the world continues to lend them money and keep their GDP looking decent, keep all these people with jobs, but the second you cut them off from increasing their debt levels, you can see what's happening. They are collapsing right now. So perhaps the repo madness is stemming from China. There's other rumors that some oil speculators had a huge blowout with the spike in oil and then the drop in oil prices. So still trying to get a better idea of that. Draghi is open to modern monetary theory and people's QE. So instead of giving the money to the banks and letting it flow from the top down, now they're talking about directly giving it to perhaps the government and then letting the government disperse it directly to the people, which may not be a terrible idea unless it makes everyone lazy. New sanctions on Iran related to China, sneaking in oil, watching this develop. Impeachment odds plummet. A lot of dirt on Joe Biden coming out. So now it looks pretty clear it'll be Trump versus Warren, which I don't think will be in the Democrats' favor, but we'll see how that plays out. Daniel DiMartino used to work for the Fed, one of the people I like to listen to in terms of trying to get an insight on what the Fed will do. And basically her bottom line is they're going to have to restart QE and increase their balance sheets because of this repo, proving that the banks don't have enough capital in them. Or there's just some banks that they don't want to lend money to because they believe they won't get repaid. Rudy was all over the news last night, this morning, talking about how he had set up this trap for the Democrats and that it was to expose Joe Biden and all the money he took from China and Ukraine. So it looks like this whole impeachment thing is going to fade away. Of course, the market did not like that. If you want to read this, you can always click in the description box and there's a link to our live stream. Here's a look at the charts I follow. Carefully watching Germany and South Korea now, as well as a couple banks more so. So in the morning everything was selling off, but just minutes later all of these were starting to perk back up and still floating higher as we speak right now. SPY looks like it's ready to break into new highs on a farm deal. At the same time, the Fed is lowering interest rates and gearing up for QE. So if that all comes together at once, I believe there will be massive outflows of these negative bonds or junk bonds and a big inflow into U.S. equities, which are still very strong relative to really any other investment opportunity out there. You got to think, where else would you invest your money? And depending on the scope of the U.S.-China trade deal, I'm worried about gold prices, but I think the rest of the world's in enough trouble and stuck in a place where they have to lower rates and print money that it still makes sense, even with a farm deal, to remain long in our gold and silver positions. Now, GDX we're buy and hold, but silver's a much more volatile little animal, and so I'm really playing the reversion where silver needs to catch up to gold with the Tuesday trade, and we're protecting it with the put option below and call options sold above to finance the put. So it's been a little rough for us on the SPY. We were expecting it to be breaking into new highs this week, but we've had all sorts of drama holding it back. I believe it is ready to at least get back to that 300 level, where there's a lot of people who are selling call options and making it relatively difficult to get beyond that point. So we may need some more positive news from Trump on the trade deal to finally break through that. But I do suspect that we are going to have a period of peace with the China-U.S. relationship, and potentially they're already buying farming goods, so we'll see how that develops. The expectation is in 2 weeks they will continue the talks after most recently meeting with our team this week. So we'll see what comes of that. Of course, they've told us they're going to do this before, but now they're actually making purchases. So that's interesting. TLT is having a little sell-off. We caught that sell-off by, again, selling the in-the-money call and buying the in-the-money put. Allows you to own the asset and profit from a down move. But we're back to long the TLT, and that position has really came in handy today. If we look at the rest of the central banks, it looks like this trend will continue. Another look at that sell-off in the TLT. Here's your Russell 2000, Stanley Druckenmiller's favorite indicator for the health of the stock market. And it is on the verge of breaking towards that 173 level. If it starts to break out of this resistance it's at right now, we may have a very strong bull market ahead with everything kind of coming together perfectly for equities. Now, on the other front, if trade war breaks down, I think the bond push will dramatically go farther in our favor on the TLT, and we'll need to play the downside in equities. Just right now, it doesn't seem like that is going to happen. Emerging markets still in nowhere land. No trade deal, it probably breaks down to that 2016 level or worse. With a trade deal, a real trade deal, I would consider playing this on Tuesday, either emerging markets or USO, depending if China's going to buy up a bunch of US oil. But this could have a 20% move just to get to that most recent high. So I do like emerging markets if we have a real trade deal at some point. Germany is probably the better indicator of the health of China than any report out of China, as it's a key trading partner, and you can see it's stuck in nowhere land. South Korea, another canary in the coal mine, looking pretty weak, but a lot of buying at these lower levels. So keeping a close eye if this were to dip significantly lower. Probably a good surge in the bond market. FXI I've put back on our watch list as it primarily hits the Chinese banks and construction companies. So maybe that is what's causing this repo madness. So keeping a close eye on it. Once again, that's China's large cap ETF. We were looking at shorting it as a way to profit from a U.S.-China trade war, but I think there's a much better way to do that. It does look like China has the means to prop their stock market by simply devaluing their currency, printing money, and buying up these shares of their own company. So now, while we have seen some pretty good volatility in 2016, that was not in the face of a trade war. That was just in the face of their own internal problems. So we'll keep a close eye on that. GDX getting a lot of volume right now, and the reason why is central banks are buying up gold at the 1500 level, and as they run out of gold to soak up, they're going to start buying from the miners. So the miners are getting their operations back intact and trying to generate some nice profits. So you're seeing people like Stanley Druckenmiller aren't buying spot gold, they're buying the mining companies. And the number 2 largest position in GDX is GOLD, which is Stanley Druckenmiller's single pick for stocks. Remember, he has a 30% annual return for his entire career, so it's good to take note. The other big one is NEM. That's the biggest position, and that's all your huge banks own most of that, like BlackRock and other big banks. Here's SLV. You can see it's picking up some serious volume. A lot of people are expecting its price to get closer to the ratio of return that gold has had, so it has a lot of catch up to do, and that's why we're seeing a lot of uptick in that. If it does play out anything like the 2008 crash in terms of the amount of money that's going to be printed to support all the debt we've put on the books, this has a huge runway ahead. And so until the central banks start to become confident and stop printing money and lowering rates, I think this is a very smart play for the foreseeable future. LQD is your investment grade bond ETF. Higher this goes, the lower rates for corporates to borrow money and buy back their own stocks. So until this really crashes, it may be very difficult for the equities to have a serious pullback. The stocks, the corporations don't really care if they have a short-term loss in their asset. They really just want to prop their stock, keep their credit rating high. And so this cycle seems to be very difficult to break at this point in time with central banks in the path of easing rates. The junk bond market is not as low of a rating as a credit, or rather interest rate, as it was in 2013, but it is looking like it's getting very strong and going towards lower rates. So that helped that Russell 2000 get out of its zone. Here's HSBC. A lot of rumors that they were helping China protect the value of their currency and potentially lost a lot of money trying to use the futures market to protect the Chinese currency. And obviously that didn't work very well. People were getting fired left and right in the bank over the last few weeks. So keeping a close eye on this, and you can see pretty good sell-off, not a huge sell-off. Deutsche Bank clearly having trouble for quite some time, down 50% in the last year. And perhaps this is maybe one of the banks. From what I know, they've fired a lot of people and have been able to manage their financial problems. So I don't think that's the cause of the dollar shortage, but keeping a close eye on it. CNH is your conversion from the offshore yuan to the dollar, and this has been a big move from 2018 to current. My expectation is if the tariffs rise, we can get a push from 7.1 right now to above 7.4, and if we go to 50 to 100% tariffs, this would go well above 8. And I think this will be the single best way to profit from a collapse in China, more so than trying to short their currency. Now, I've been looking at Interactive Brokers. They did have some options on this, but it doesn't seem to have any market. So it does look like we'll have to use the futures. So we want to be selling the CNH against the dollar. All this means is we want to sell the currency at today's price and then buy it and the future price at a discount, so we can make a profit. Each contract will represent $100,000, so it's very, very efficient in terms of commission costs to do these. And essentially we'll be recommending to our boot camp members only because it's a futures market and not really part of our normal stocks and options when we think is a good time to enter this contract. But in general, if we can get a move to 7.4, I think that might be the next level it goes to. That's about a 4% change. So if you have one contract that will represent $100,000, and if I'm correct, we would be able to return 4% on that contract. So about $4,000 potential profit per contract. So if you are in the boot camp, you may want to make sure you're approved for futures trading. And this is a look at a sample of what one of those trades would look like. Now, we don't want to pull the trigger on this until Trump comes out with the tariff. Once we see what the new tariffs would be, we can calculate what they may devalue their currency to offset those tariffs. But again, it looks like we may get a period of peace here. So the time to do this is not until the tweet comes out. We'll have some time for Chinese to react and then devalue their currency. And so this is the way to do it. And again, so if you had a $100,000 account, I would only buy one contract and only try to make a 4% total return. Well, it depends on what the tariffs are. If they're saying a moderate rise in tariffs, I think 7.4 is a pretty reasonable pretty reasonable expectation of where they'd push the currency to next. Here's a little look at the change of price of that futures contract, which has been rising. You can see the competing currencies continue to lose value against the dollar, which further pushes this narrative that the rest of the world is struggling and that the best place to invest will be U.S. equities in a world where bonds are at a negative yield and we're entering perhaps a period of peace. So there may be a rush to get out of all these bonds at some point because a negative yielding bond is going to lose somebody money one way or another. No way around that. The Japanese currency continues to be weak. Gold staying up at this 1500 level, which I think will remain at this level until central banks aren't printing so much money. Crude still at a decent price to keep everything churning in the U.S. Not too cheap to show a growth scare, not too expensive to create inflation and force the Fed to raise rates. We've got our German bond continuing to slip lower and lower, which is how we predict the U.S. rates. And I think it's a good time to buy the dip on your crypto, guys. So that's a wrap for today's update. And again, if you missed today's trade alert, call Dean 505-322-7515. Our paid member webinar starts in 10 minutes, so we'll see you guys on there in a minute.